So I'm going to talk about the exciting topic of insurance. So like I was giving in my 1-minute presentation, I specialize in life, critical illness, and disability insurance. Last time I gave a presentation to B&I, we talked about how insurance protects your financial plan and the likelihood of this happening. Today I want to talk about a specific strategy it's been called a few things. One of the main name for it is infinite banking. So essentially how you can use insurance in your financial plan or as a financial strategy. So overview, so I'm going to talk a bit about me. Keywords that you should be excited to hear about so you know to think about referring me and think about insurance. I'm going to go over the two major kinds of insurance, term and permanent insurance, and then I'm going to talk about the infinite banking concept, and then I'm going to do a quiz. So maybe take notes. We got prizes. It's going to be lots of fun. Get ready for it. Okay. So about me, I was born and raised in Vancouver. I graduated from the University of Victoria, did geography and business. I started in the industry in 2010. Won the top producer in the fall quarter, and then went independent as a broker in 2011. In 2012 last year was the top 3 brokers in the brokerage out of 600 brokers across Canada. So factors that affect your life insurance needs. So these are keywords. If you hear them, think about me and think about referring insurance. Having a child, getting married, buying a home, taking on debt, business or tax planning, supporting aging parents, changes in your business, changes in marital status, planning for retirement. So anytime you kind of hear these sorts of things, you're out and about, they're probably going to want to review their insurance plan. And it's going to be a really easy referral for me. So what kind do I need? The two major kinds is term and permanent insurance. Term insurance is mainly for a specified period of time. So you're going to have coverage for a certain time period. It pays if you die during this period of time with life insurance or critical illness insurance. There's no cash value. It's the lowest cost. So because you're covered for a certain period of time, the way you gain a claim or get a claim is if something happens to you during that period of time. If nothing happens, then there's no claim. Because of this, the cost for the insurance is quite low. So term insurance is going to be the most cost effective. It's ideal for short-term needs, so i.e. a mortgage, or if you're protecting for your kid's education or something like that. Where permanent insurance, it's going to be coverage over your entire life. So this is lifelong protection. You can build cash values in the permanent plan, which we're going to talk about in the infinite banking strategy. You can build wealth within an insurance plan, and you can have access to leveraging these policies as well, which we're going to get into more detail. There's creditor protection in the policies, and the money is passed on tax-free. All life insurance is tax-free to beneficiaries as well. So this is useful in certain investment strategies. It can also be useful covering capital gains and estate taxes. So it's mainly used for estate planning and planning for capital gains and that sort of thing. So, the infinite banking concept. So, I've gone into this with a lot of people and a lot of in the group, and a lot of people were asking more questions on it and wanted more detail. So I thought I'd really focus on it on my presentation today. So it's a strategy. Essentially, it's a strategy to build wealth within an insurance policy. So why would you want to do that? There's some main advantages. But the idea of the concept is that you finance everything you buy. So when you're purchasing a major big ticket item or a major purchase, you're either going to pay cash for it, you're going to lease it, or finance it. So when you pay cash for it, you're pulling money out of your savings account and paying for it, which means you're losing the interest on that money that you would have been earning to purchase a major item. When you lease something, you're going to be making payments to a company, and you don't actually own that asset. When you finance something, you take a loan to purchase it, you're going to be paying interest. So what the infinite banking strategy comes up with is a way that you can purchase these items without losing the interest or the opportunity to earn on your money. We'll get into that in further detail. So like I was talking about before, what are the advantages of doing this? Well, one is the ability to finance your major items. But through a whole life insurance policy, what you're going to be able to do is grow your wealth through cash accumulation. All growth within an insurance policy is tax deferred. So what that means is when you put cash into one of these policies and it pays a dividend, all that is not actually going to be taxed until you withdraw it. The advantage is you can leverage against the money in this policy. So when you leverage against the cash in the policy, you don't actually pay taxes on the loan. So you use it as collateral. So it's a way of growing wealth and then having access to it without paying the capital gains on it. It allows there's life insurance with it, so it's going to fund your estate. So the idea is you leverage against the policy, and you use it for your major ticket items. And when you pass away, it's going to pay life insurance to your estate, tax-free, like we were talking about a little bit before. The money is protected, so there's creditor protection with life insurance. So someone can't actually come after you and sue you for your life insurance policy. It's looked at as life insurance. So the money in this policy is creditor protected, so it can be used in a lot of ways with businesses to guard against that. And it's liquid, so you can take out a policy or a loan against the policy quite easily. So how does it work? So the idea with the infinite banking strategy is to structure a policy, an insurance policy, that has as much cash as possible. So in order to maximize the borrowing ability and the use of the actual insurance policy. So the idea is that the sum in the insurance policy is there. That I'm not losing it. The sum in the policy is there's a cash value in the policy that you now are going to use to borrow against to purchase major items. Why you want to borrow against it instead of withdrawing it is because you actually leave the full principal in the insurance policy. So say, I have an example. So say you have $100,000 in your infinite banking system or in your insurance policy of cash. Now, with a normal, say you're going to purchase a car. When you normally purchase a car and you have $100,000 in your savings account, you're going to withdraw $50,000 and purchase that car. That now you'll have $50,000 in your savings account earning interest, and you'll own a car. With the infinite banking strategy, what you want to do is you borrow against the $100,000, and you use that $50,000 to purchase a car. The entire $100,000 is still in your infinite banking system or your insurance policy, earning interest. And now you use that $50,000, purchase a car, and what you can now do is, instead of paying a financial company back, you now pay yourself back the interest, and it's a way of capturing that interest, if that makes sense, if I'm not getting over everyone's head. Now what you can also do is, if you have $100,000 in your policy, instead of purchasing a car, why don't you sit down and talk to a person like Micah, borrow the money, say $50,000 out, give it to Micah to invest. Now he earns, say, let's say Micah does really well, earns his 10% on your investment. Well, now you're earning 10% on that loan, and now you can pay yourself back on top of that. So essentially why it's called banking is you're creating wealth like a bank would by leveraging, by creating money, if that makes sense. So I did an example. I don't know, how am I doing for time? No time. Okay, well, you're like, you're way over. Okay, we'll save the example, but I know I kind of just really kind of hammered away a somewhat complex strategy. So I'm sure you guys are going to have a lot of questions, and we do have question times. I want to do a quiz, so it makes it more fun. And I have Starbucks gift cards. I do this every time. So, anyone? Name 2 benefits of the infinite banking concept. Dave. All right. What do you?
I believe that 2 benefits would be, first and foremost, you're always going to be gaining interest even if you take money away from your policy.
Yeah.
And I believe that tip of my tongue here.
So Somebody else.
I can see it.
Okay, hold on. There's many benefits actually. We went through this before. Another benefit would be.
Yeah. Oh, no. I'm gonna take him out for coffee. All right. The difference between permanent insurance and term insurance, JP.
Term insurance is short amount of time for for usually assets and whatnot, and you don't have cash value inside of permanent insurance. Is usually whole life, it's long term, and
yes. Wow. Yeah. Name 3 keywords to look forward to referring your business. Micah.
No, that's enough.
Okay, so
I don't know what shit.
Having a baby, taking on debt, buying.
Oh, wow, you took notes.
Oh yeah.
Seriously, Starbucks, eh?
All right, and then we got one more for when we do the draw as well.
Okay.
So, any questions? Yes.
So the like when you're setting up the infinite banking strategy, do you have more than like one provider that you?
Yeah. So
like a pool of...
I'm a broker, so I work with every major company in Canada. When we do set this up, we recommend working with a mutual company.
Okay.
Why is because when you're an owner of these policies, you're also a shareholder. We're with a publicly traded company. There's outside shareholders. So when you're going to be a policyholder, it's also an added benefit to a shareholder, and you know that company is going to be working in the best interest of its shareholders to actually pay out a dividend. So
I have one more question.
Yeah.
Is there low risk and high risk investment strategies that can be sort of implemented based on the client's power?
yeah. So with a universal life policy, it would be invested in different markets and in different funds. With a whole life policy, it's actually invested directly within the company. So it's not invested in the market, and the dividend that's paid out is in the account. And so if in the future it stops paying a dividend, the cash in the account is still there. So the actual cash isn't going to fluctuate.
So that's the low risk policy, right?
That would be the more lower risk, where if you wanted higher risk, you would
funds.
get into the universal life, and that would actually fluctuate with the market and be higher risk.
For the banking though, the lower risk works better because it's lower risk, you can leverage it more.
Mm-hmm.
Universal life has risk, so you can't leverage it as much.
Okay.
Unless you transfer it into something
Any
like
other
a low
questions?
risk thing like a GIC or something.
Yeah. Yes.
Probably it's gonna be, maybe you, Rachel, and your brother in the same question, because it's pretty much not the same as the RRSP with the infinite banking strategy, right? Because you say like if you're leasing, let's say a truck for your business, then it's gonna be pretty much paid off from your taxes at the end of the year. But what about if you put it in the infinite banking?
So the infinite banking, putting in an insurance policy is not tax deductible. So with your RRSP, it's going to be tax deductible. So you're going to reduce that from your earnings. Where with this, you would pay with it after tax dollars, or you would have it owned by your corporation.
So
But it's not taxed.
It's not tax deductible.
Is there an advantage to paying tax now or paying tax later?
Depends where you, yeah.
Depends. So that's something where Rachel's going to be obviously going to be able to sit down with you, and that's where she's really going to be able to advise you.
You can also avoid probate, things like that. Is for estate planning, it's related.
Mm-hmm. Definitely. So yeah, we'll leave it. We'll leave it at that because it's going to get complex. If you guys have any more questions, do a BBI with me, and we can get into more details. Definitely, either way, we're going to sit down with Rachel and Mike and tie it all together. Woo!